Bond yields back down real low after the rally we've seen in treasuries. Investors came into this year worried about duration risk. Now maybe the problem is they're not getting much yield at all. Let's bring in Barry Martin, portfolio manager and of option strategies at Shelton Capital Management. So Barry, your team is looking to options and equity derivatives as a way to supplement, augment, protect a fixed income portfolio?
Yeah, I mean, thanks for having us on. Yeah, what we're doing at Shelton Capital Management in our mutual fund, EQTIX, is that we're selling covered calls and generating income on a portfolio of large cap equities that are quality names. And you know, with interest rates being as low as they are, our fund is currently paying over 7% on a 12-month trailing yield. Okay, so 7%, that's a heck of a lot more than I have to buy like a high risk, high yield bond to get into that realm right now. And you're doing this by selling options? Yeah, exactly. So, I mean, the last couple of quarters, obviously we've had a higher growth, high inflationary environment. So it's tough to own fixed income in this type of environment. So an alternative, people are looking for alternatives. Why not own large cap equities that are quality names and sell covered calls to generate cash flow? So that's exactly what we're doing. Now, let's see, over the last couple of weeks here, the fund has taken a hit. So is that just because volatility popped, and so the options that you're selling are getting taken up, or what's happened here? Yeah, I mean, so what we own, we typically have a value tilt to the portfolio. So as we know, we've seen value do well at the beginning of the year, and it's starting to take a turn, either go sideways or back to growth. So some of our value names, the energy stocks, some of the financials, industrials and materials have taken a hit. But compared to other value funds, we've done very well. And we've done that by selling covered calls. We've offset some of that exposure and taken in that cash. Our last quarterly dividend was 46 cents. And so what we do is when we generate those gains on selling those calls, it's paid out quarterly to our clients. So it's a value tilted fund, but with less exposure because we're selling covered calls. Got it. Okay, so this is still a value-oriented equity fund. That's going to be your benchmark. Now, okay, so the correct call options that you're selling is basically kind of a wrapper in a way to generate more income for the fund, add some protection to it, limit, I guess, downside. This is not just like a pure income options play. Well, exactly. I mean, so, as you know, with covered option writing, most of your returns are the underlying equities. And so I like this fund because, it's an active value fund, right? And how often do you get that? Most of the people it's buy and hold, and you hold it forever and hope things go up. So we're actively selling calls. We're reducing exposure in some areas, adding exposure to other areas, locking in those gains, paying out quarterly. And it makes, TD Ameritrade has done such a great job, educating the advisors and clients across the country. And, there's a lot of benefits for selling covered calls. One is obviously income. That's probably the main reason why they use it. But I also like to use it because, it's a standard deviation reduction. So we're lowering risk. Our standard deviation is around 14. So we're getting similar market returns with a third less standard deviation. And that's important for clients, and especially important in this type of environment. With volatility spiking, we're able to take more off the table and really reduce the risk of this play. Also, people like to use it as a total return strategy. It's, depending where they feel the market's going to be. If we're going to go sideways and stay in a choppy market and go sideways, this is where you want to be. You want to sell covered calls, take money off the table, and receive that quarterly dividend. Barry, the top sector holding that I see in your latest fact sheet is in banks. But in the top 10, you've got some of the giant tech in there, Apple, Facebook, Microsoft. So those have not gone omitted. One thing I'm curious about, you've got 96 holdings as of this report, 87 with written call options on them. I'm curious where that discretion is. Do you not want to write options against the best performers? Do you not want to get in the way of the gains in companies like Apple, or how does that determined? Yeah, as you can tell, I mean, we have a lot of holdings, but Apple's our largest holding with just over 3%. So when you're writing covered calls, we don't like to make big bets on certain equities or certain sectors, because when you write covered calls, you also cap the upside. So if the speed limit's 65 miles an hour, I'm driving 55 miles an hour avoiding potholes because of the asymmetric returns of selling covered calls. So, so we feel diversification is important in this type of fund, and also obviously the selling the calls and not putting all of our eggs into one basket. So, we're hitting singles, moving the runner over, playing basic small ball. We're not trying to hit home runs. So you won't see like huge weightings in individual stocks. But we do like quality names and quality companies that have strong fundamentals, low leverage, and those are the type of equities that we'll own, where we think it's beneficial to sell calls and take money off the table and pay that out quarterly.
Okay. Barry, thanks for the walkthrough on the fund. Looking forward to tracking it and continuing the conversation about what you see in the market. Good stuff.
Thanks. Take care.
All right. You got it. Barry Martin, portfolio manager of options strategies at Shelton Capital Management.